Hey guys, Sean here, and we need to talk about buying the dip. Now, a lot of things has changed over the last couple of weeks, and this crash is about to get much worse. Now, the signs of a recession are getting clearer, and this will just spill over to the stock market and set it on fire. We are going to go through two big shocks that the market is going to face very soon. We will take a look at history that shows us there's still enormous downside left, and answer the $1 trillion question. Should you still buy the dip and dollar cost average into this black hole? We'll go through equities, we'll go through gold, as well as what you must know before you decide to continue throwing money into this financial barbecue. Now, firstly, a lot of us are forgetting what is running today's modern economy and what's popping up the entire stock market. I would argue it's no longer innovation or hard work, it's cheap money and credit that are about to vanish courtesy of the Federal Reserve. There's going to be a massive rug pull from the Fed, and these 2-3% drops are nothing compared to what's about to happen when people realize that money is really leaving the system. Remember that it was low rates and increasing money supply and stimulus checks that really kick-started one of the most aggressive bull markets in history. How intense was the bull run? Well, it took the S&P from 800 all the way to 4800, which is an annual return of nearly 11%, which is unheard of when the economy was only growing between 3 to 5% on average during the same time period of 2008 to 2021. Do you really see the disconnect here? The stock market is overvalued compared to the reality of the economy. But it wasn't just low rates. We also enjoyed low inflation that only averaged at most 2 to 3% as well. And this caused spending and investing boom. Everyone had money to spend. Companies could grow thanks to near zero interest rates, and low inflation meant that essentials like food and fuel could really keep pace with salaries at least. You didn't need to liquidate your assets to put food on the table, and remember, it's both low interest rates and low inflation that ushered in this incredible bull run. But all this cheap money is going to go away. The Fed has raised rates by 75 basis points and is committed to pull out $95 billion a month from the system, and they are going to drain trillions of dollars that they created over the last 2 years. And we are already seeing signs of an economy that's about to break. Now, when you pull out all this excess money by selling bonds, bond yields are going to fly to the sky, and this makes it harder for companies to grow. We can see the 10-year treasury yield going from 1.4 to nearly 3.5%, and that means the cost of borrowing for companies is going to be much higher as well, and the interest payments on their bonds could easily double or even triple. Now, companies can no longer grow as fast as before, and this is reflected in a falling GDP number. The economy shrank by 1.5%. People aren't spending as much as before. Companies aren't throwing cash like in the good old days, and it all has to do with sky-high inflation. And if you take a look at the real inflation numbers, we are seeing energy inflation at around 35%, and food prices inflate by at least 10%. Now, spending habits are changing, and I'm sure many of you are already doing cutbacks on your budget across everything that you buy. So understand that people just don't have enough money to prop up the stock market during this period. There's less speculative money around, and if you are buying the dip, there aren't going to be a lot of buyers that will cushion your fall. But inflation doesn't just affect you and me. Companies are going to find it more expensive to produce their products and services. The Producer Price Index, the PPI, has been spiking up since 2020's money printing, and that tells us that the cost of goods for companies are going to go up too. And what are companies going to do? The first thing they're going to do is start laying off people, and that's what we are seeing right now in the tech sector. And this is just the beginning, guys. We are seeing companies just outright firing their employees. This is the canary in the coal mine, as tech companies are some of the highest leveraged entities on planet Earth with extremely high salaries. Now, investor money is drying up, and this situation is no longer sustainable. And this is why we are going to have a negative demand shock coming soon. Think about it. If you're someone who just got laid off, your salary is gone, but you have a mortgage to pay and food to eat. Of course, the majority of your money is going towards survival. You are cutting out all discretionary spending at once. You won't have the money to speculate in the stock market. You won't have money to buy Bitcoin or other shitcoins. Your cash will go to food and fuel. We can already see consumer sentiment dropping to an all-time lows. people are just not spending and buying stuff like they used to. But the story gets even worse with the supply shock that we are going to face. There's been a lot of talk from the mainstream about peak inflation, but this inflation train isn't about to stop anytime soon. I think we can truly kiss the target rate of 2% goodbye over the next 2 or even 3 years. And at this point, it's just wishful thinking. Now, we know that the war in Ukraine has caused oil prices to spike, and the conflict just seems to be escalating, and there isn't any end to it anytime soon. Now, Putin and Zelensky don't seem to be too keen to iron out a peace agreement, and the rest of NATO is busy arming themselves with American-made weapons. Now, the longer this war drags out, the longer the price of oil will stay elevated, and the economy is just one step closer to breaking. Now, everything today relies on oil to run or produce, and that includes the fertilizers we need to grow food. But domestically in America, the oil shortage can't be solved as well thanks to the policies of the Biden administration. Now, oil and gas companies just don't have the refining capacity to produce gasoline and diesel to lower gas prices at the pump. It's painful to the consumer, but prices could continue to rise. There have been calls for a windfall tax on the oil industry, a 21% profit tax to really squeeze them for making record profits, but this could just alienate big oil and cause them to invest less for future production. This is just going to make high oil prices last for a much longer time. So now we have a situation where food and fuel prices are high, layoffs are happening, and family budgets are decreasing. And this means there's going to be a lot of money that could be put off the stock market or bond market to pay for living expenses. We can kiss goodbye to the speculative money chasing a return because everyone is focused solely on staying alive and making it to tomorrow. We are going to see money continue to leave the markets for quite some time, and deep buyers are going to be catching a falling knife. We cannot underestimate how far the markets are going to drop. Now, if we take a look at the previous two bear markets, we can see that in the '08 crash, there has been an epic 57% decline over 15 months, while the dot-com bubble crash in 2000 saw a 50% drop over 2.5 years. Now, a crash doesn't just happen over a matter of weeks or months. It takes time for momentum to gather and people to gradually lose faith until capitulation happens. But this bubble is unlike the previous ones because of all this cheap credit and easy money sloshing around the system. It has caused valuations to just skyrocket. Taking a look at the Shiller P ratio, we can see that the stock market valuations are still too high. Now, the average is around 17 and we have come off record highs and we are still sitting at 28.4. There's still more room to fall back to the average, and this should be worrying to investors because we have not seen capitulation just yet. We are still seeing headlines telling people that the drop is temporary, doubting if the crash is the big one and maybe it's time to get back into the market. What I want to see are the headlines on the news sites, the Wall Street Journal, CNN, CNBC, all turn bearish and call for the end of the world. Now, taking a look at the S&P to gold ratio, we can also see that the S&P 500 and gold met 1:1 multiple times in history, back in '08 to 2012 and during the majority of the late 70s and early 80s. Now, this meant that a single ounce of gold could buy one share of the S&P 500, and we are sitting at 2:1 and falling fast. So right now, the S&P is around 3,670 while gold is 1840, and if history is any guide, we can see the S&P fall in price while gold could appreciate in price, and they meet somewhere in the middle. Unless, of course, both of them falls, but the S&P just craters faster and gold, and they meet at a crazy low levels, right? Maybe at 1700, maybe at 1600, who really knows? And I love this measure because it's unrelated to any earnings or metric companies traditionally use, but to use real money, gold itself, as a gauge of the stock market performance. But back to the topic, it's going to be pointless to try and pinpoint a bottom price, but seeing the indicators, we can tell if things are becoming more fair valued or if the market is still truly overpriced. So here's the trillion-dollar question. Should you still dollar cost average in this market? Are we throwing away good money down a black hole? Now, firstly, you need to realize that it is highly likely that the markets will continue to bottom out and reach new lows over the next 6 or 12 months. It is not confirmed, but we have not seen the true extent to which the Fed can go to combat inflation. Remember that if we want to see a real sustained recovery and head back to a bull market, we need to see both inflation and interest rates come down. Companies need low rates to grow, and people need low inflation to have excess money to invest. However, there's still a big disconnect here. The Fed funds rate is at 1.75% and is projected to double to 3.5% by 2023, but inflation is still red hot at 8.6%. Now, if you really want to fight inflation, you need to go back to the Volcker era. You need to hike rates above the inflation rate. But if they do that, it will implode everything. Stocks will crumble, housing will collapse, the bond market will be set on fire, and I don't think the Fed has the guts to do that, at least not right now. So if you're thinking about buying into this market, understand that you are catching a falling knife. The moment you click the buy button, there's a very good chance the market will fall further and you are further in the red. Now, sure, there will be multiple rallies along the way during a crash. There will be fake outs, there will be bull traps and dead cat bounces, but you really can't time those. Nothing really falls down in a straight line. Now, if you're averaging in to build positions, you have to make peace and be okay with this. But if you're investing now and banking on the Fed coming in to save the day and reverse course, you might be disappointed. I think the Fed put is off the table. Now, obviously, a reversal could happen, and to me, I'll label it as a black swan event. If the Fed decides to suddenly lower rates and print money again, it will send everything soaring to the sky, and it's not because the market is strong once more, but because it would likely cause hyperinflation. The dollar will be increasingly worthless at that point. Now, as long as we are in this hellish limbo of rates rising slowly and inflation still sky high, things will likely continue to implode further. However, as I mentioned earlier, if by some miracle the Fed manages to get inflation down and then start lowering rates back down as well, then I believe we are in for another fantastic bull run again. But as of this moment, I don't think that's really likely. For myself, I've cut back my investing budgets by 2/3, right? I'm just working with 33% of what I normally used to. And if I see the market slam down by 10 or 15% at a time, I'll be picking up some shares because I can't time the reversal as well. So if you see some weirdo picking up a few shares at a time on the order book, that's probably me. I'm buying in very slowly during the big crashes. I'm reserving the bulk of my cash when there's blood in the streets and the headlines are screaming for the end of the world. They're screaming Armageddon. Now, obviously, you have to make your own decisions and decide if you still want to dollar cost average down, especially if you had been conditioned to buying into the market over the last few years. You shouldn't follow what I'm doing, but understand that we have never really seen the true bottom of the market, and the recovery could take 3 years, it could take 5 years, or even a decade, because during the past few crashes, the Fed stepped in, lowered rates, and flooded the economy with funny money. So if they decide to let this recession ride out and let us go through this pain, which I would argue is a good thing, it won't be a surprise if the markets don't recover for a whole decade. Now, I'm not blind to that, and that is why I'm not going all in. In my opinion, there's still much more pain to come. But what about commodities like gold and silver? Now, if inflation is high and rates are rising, yes, this will keep commodity prices quite strong, but we need to understand that money is still leaving the system. People are just spending less. Commodity prices like food and fuel will be kept high because people still need to buy them no matter what, right? You still need to eat food to survive. But investment money to every other asset class is also drying up. And we need to redefine the word strength during this market crash. If an asset class isn't cratering to earth today, it can be considered as strong as people still view it as valuable enough to hold on to. Gold, for example, has returned less than 2% year to date, but compared to the S&P, which is down by 23%, or Bitcoin, which has crashed to hell by almost around 60%, we can all agree that gold isn't doing too badly. But once we reach a capitulation point where everyone starts giving up and starts selling everything, I won't be surprised if precious metals also takes a hit down as well. Then again, you shouldn't be holding gold to chase returns. It should be there for wealth preservation and to remove counterparty risk in your life so that you have access to your money when you need it. So if you're buying into gold to remove financial risks, to have physical wealth in your hands that's no one else's liability, then by all means, don't let the price shock scare you, because even though the spot price might drop, if physical demand is high enough, we can see the premiums rise and there won't really be much of a difference. Now, obviously, this is one of the craziest times to be investing, and there's no place that you can hide. There's no asset that's 100% safe in this environment, and as much as I hate to say it, cash is becoming more attractive at this point because we are still coming off record highs, and life support is going to leave these zombified markets very soon. And if you still decide to buy the dip, you will continue to see red, you will be burned, and no one has a crystal ball to say how low we can truly go. You need to make peace with that. So are you still buying the dip? Let me know in the comments below. Stay safe, and if you enjoyed today's video, be sure to smash the like button and subscribe for more videos as we navigate through this economic hellhole. Thank you guys for watching, and I'll see you soon.